Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast coming at you right now. And this is going to be an exciting episode for all of you listeners. I think we've got a guru in the house by the name of Venkat Avasarala. And one of the coolest names we've ever had on the show, that's for sure. And Venkat is currently working on ground up multifamily projects mostly. He does have an extensive background in the value add space. And in fact, he sold 3,000 units just last year in 2021. So that's amazing. And I would say very well timed. He owns 400 units still, and he's building 2,000 units. And he's got a goal to build 10,000 units. So he's great at putting deals together and putting teams together. And sounds Venkat like you're a lot like me, where you're kind of a deal junkie almost, where you like to do the deals and be out front leading the pack. So I'm really interested to hear all about, your story, kind of how you got to where you are today, and your progression in real estate and in business. So if you could kind of start us off, at the beginning of your career, business wise, and just catch us up with how you got to where you are today. That'd be great.
Absolutely. Hey, first of all, thanks for having me, Tate, on your podcast here.
Yeah, you bet.
So, I'm an electrical engineer by education. So came to the United States back in 2002, originally from South India. After getting my master's, ended up in IT, worked for 14 years for companies like Bank of America, Pepsi, Halliburton, and so forth, all in IT. And then started commercial real estate in 2016 as just a side gig. I have no idea that, this will become my main profession back then. So I started out by buying, B and C class apartments. Before that, I did about 20 single family homes. Like most people, I started with single family, just kept in my portfolio. But once I kind of hit the 20 unit property ceiling, before Great Recession, there was no limit to how many Fannie Mae loans you can get. But after Great Recession, they kind of put a cap on 20. So they will not give you more loans than 20. So that is when I moved to apartments and ended up buying one after another. My very first property was a 100-unit C-class property in Norman, Oklahoma, for all places. After that, just bought several properties in DFW, some in Phoenix, some in Denver. So these are the three cities where most of my portfolio used to be, like in Dallas, Denver, and Phoenix.
Okay.
And last year, I sold all my Dallas portfolio and basically exited Texas completely because everything changed from the time I entered into Texas to now, namely property taxes and insurance. Used to be non-issues. I never talked about those back in 2016, 17, 18. But 2018, 19 was like a watershed moment where the property taxes and insurance both started to spike up and basically outpacing the income. So then I saw the writing on the wall. I prepared myself. I took advantage of 2021 incredibly low interest rates and all that, and figured that was the best time to exit. And more to do with what's going on in the country also with this high inflation, and even the pandemic disproportionately hurted our C-class tenants more than anybody else in the apartment tenants world. So I found that as a good opportunity, exited everything. And early 2020s when I set my sights on ground up development, because before then there was not much demand for Class A product. I don't know where this demand came from. I have some idea where it came from, but it just magically came, this demand for Class A product. And suddenly people started saying that, well, we are short of this many units, that many units. Nobody said anything about that before 2020. And suddenly, okay, so if there is a scarcity, let's do our part to go fill it, right? So that is when I came up with my vision of building 10,000 units. Again, I'm not thinking that this boom will continue forever, this Class A, this ground up and all that. But while it lasts, I intend to make most and provide some good quality opportunities for my investors to grow their money.
That's a great progression. Let's just rewind a little bit and unpack this. When you started in 2016, you said you started off with single family, right?
I started with single family back in 2012. 2016 is when I started multifamily.
The commercial. Okay, gotcha. I'm curious if you could take us back to that 2016 moment. Was there what inspired you to go into the commercial multifamily space?
So, like I was saying, right, I was doing single family homes. I was very happy with them. It's all my money. I was buying them for cash flow. They used to cash flow 15% on day one. Income minus PITI minus 15% of the rent set towards the maintenance, it still yielded 15%. Otherwise, I wouldn't write an offer. So we were spoiled when, back then, back in 2012, 13, 14, 15, those were the days to buy all these single family homes. So my expectations was like that, returns to be in that order. But by mid 2015, I have seen that, I'm not finding those 15% or not even 12%. So suddenly, there is an uptick in the prices and all that. And also I capped out my 20 homes. And that is when I said, I started out to look, okay, what else I can do to scale from here? Because single family, seems to be too much work, but kind of cap returns there. So I looked into several things, the laundromats, the 7-Elevens and everything looks like another job. At the time, I already have a full-time job. I don't want another job. I want something which, a place where money can work for me. And the whole point is not for me to get a second job. So then I came back to real estate and looked at several, I saw retail, hotel and everything, and just settled on apartments. And that is the point where I started looking at buying apartment complexes, but nobody would give me a deal in DFW because I don't have any experience, right?
No track record.
After looking for like 6 months in Dallas, I quickly thought like, look, we got to do something different here, because here, Dallas is very hot market. Nobody would give me a 50-unit deal because I just don't have any experience. So I went into Oklahoma, which is not so hot at the time, especially oil was still struggling at the time, and Oklahoma has a huge dependency on oil. So I was able to land my first property was $3.5 million. We paid $35 a door. Wow. Mid-60s built, 100 units right on Main Street in Norman, Oklahoma. So that was my very first deal. And my second deal, believe it or not, was in Phoenix. At the time, Phoenix was not hot, like October of 2016. So I landed an off-market property, 120 units in Glendale, Arizona, suburb of Phoenix. So after doing these two deals, I showed this experience and bought my way back into DFW. And the brokers who wouldn't give me a 50-unit property started me with 300-unit property in Dallas. That's my very first property in Dallas.
Wow, nice.
8 months ago, they wouldn't even give me 50 units. So that tells you that, they want to help you. These brokers, they definitely want to help you, meet your goals and everything, but just they need to a proof that you can do these things.
Yeah, they need proof of concept that you will close a deal. And if they bring you something that you have the ability to get it done. Absolutely. When did you, you're full-time real estate now, right?
Absolutely. Since 4 years.
4 years. Okay. So you quit your W-2 4 years ago.
2018, July.
Yeah. I really love what you did on a couple of different levels. Number one, you hit the ceiling with single family, and you looked for ways to scale, ways to assets to buy that weren't single family. You said you looked at 7-Elevens and stuff like that. And yeah, man, you buy something like that, and that's a full-time job.
Yeah.
No question about it. And as opposed to being an owner operator of large scale 100+ unit buildings, that is very leveraged work, in my opinion. Curious what you think, Venkat, but the amount of effort that you put into managing those assets and managing the property managers, while it's substantial, I don't want to devalue it too much at all, because it's so important and it's so substantial. But it's not you're not dealing with customers walking in and out of the door, and vendors, and crime, and all the things that could go along with a business, like a retail business, like a 7-Eleven. And not only did you go commercial, you went commercial large scale right out of the gate.
Absolutely.
And we have this conversation on the show a lot with people, because everybody has a different story. Everybody has a different path to get to where they are. And there's a pretty healthy debate around here about whether to start small or whether to go straight for the larger asset class. And I got to say, where I come down on this is that my opinion is that you go for the larger asset class, and you just level up as much as you can from where you are. And I love that you went straight to 100 units on your first deal. That's tremendous.
If you can arrange the debt and the equity, there is no reason to start small. I mean, it's not like your learning will be at a different trajectory if you start small versus start big or anything like that, right? So the larger the property, the safer it is, right? I mean, let's say if you have started with a 10 unit, 2 units get vacant. Well, you are at 80% occupancy now, right? And also, in any business venture, there should be enough margin, and also it should be worth doing something, right?
Yeah.
But when you start with small properties, I mean, nothing wrong with that. It's if that's what you want to do. But what I always tell people is that if you can bring partners to sign on the loan, or help with the equity or whatever you need to get the deal done, while you or the ringmaster, you put everything together, you do the asset management and all that, then yeah, at least start with 100 units. Mm-hmm. And also the broker should be willing to give you that kind of property. But assuming that you can arrange the debt, equity, and a broker who's willing to give you a property, go for it.
Yeah, exactly. And, we talk about this first deal thing all the time, and Michael Blanc's law of the first deal is so real. It's such a well-formed concept, because that first deal is generally the most important deal that you'll ever do. And ironically, for a lot of people, they would never do it again in their career because it's too small or too much work or not new enough or not a high enough asset class. However, in your world, that's what put you on the map was getting that 100 unit done. And
I would argue actually it's easier to manage 100 unit than, let's say, a 20 unit or a 30 unit, because you cannot hire a full-time property management company
right
less than 100 units.
That's right.
If you have 100 units, you have scale of economy where you can afford somebody to manage it full-time, because you're starting with zero experience at that time. So right. Yes, I mean, you could use help from the property management company full-time.
Yeah. And yeah, by all means, like when you're in I recommend any property, even single families, but certainly commercial properties, you want to be leveraging a third-party property management company. You do not want to be self-managing yourself. It is once again, a full-time job, tenants, toilets, trash, collections, leases, court cases, evictions, all those things that go along. You want somebody that is a pro, that really knows what to do in different situations, so that you're leveraging their experience and their time, effort, energy, resources, et cetera, to manage the property. And then, for listeners, you become, as the owner operator, you become the asset manager, which is a high level activity where you are meeting with your property manager generally once a week, is kind of how we do it.
Yeah.
And you're going over your key performance indicators, your KPIs, the amount of showings you've had, the amount of leases you've signed, your vacancy rate, your delinquency rate, and you're working on a high level on those different things. And then, they're going to work every day at the property, implementing your business plan. So,
absolutely. But what I would say is, like, once you hit, let's say 2,000 units or so, try to manage it yourselves. Because
to go vertical.
Yeah.
Start your own property management company. Right.
Yes. Take it vertical. You probably won't make any money on management company. Probably you'll break even at best case, but your properties will perform so much better because nobody cares about your properties more than anybody else.
More
right?
than you. Yeah.
More than you. So definitely I would recommend getting a property management company. Yes, it's hard work. I mean, now you're much more exposed to the weeds and all that, but there's no other way to do it.
Did you do that? Did you go vertical?
That's why I sold it. I don't want to do it because look, back when we bought $35,000, $50,000, $60,000 properties, you cannot lose. You see what I'm saying? So, however, your property management might mess up here and there. It's okay. We just have enough margin where it's okay. We still make a lot of money, cash flow and all that. But now, even a C-class property in a primary metro like Dallas is trading $100,000, $120,000. And the rents did not grow like the property values did. And now the insurance is high, tax is high, interests are high, right? This is worse than a McDonald's business, if you will. Razor thin margins. One wrong move, you'll swing from a small positive margin to a big negative margin, right? So now you just cannot mess it up. So it behooves upon you to manage it yourselves, but you need to have the scale. Obviously, you cannot do self-management on 100, 150 unit unless you want to do that full time. Even that, it's hard. But once you have enough scale, so that is a watershed moment for me. Last year, so I look, do I want to continue what I'm doing, these Class C properties, B properties, and self-manage and go that route? Or go do ground up development and become a developer and generate value for my investors that way? So I kind of weighed my options and went on the other way. Yeah. That's why I exited all the properties.
What was your inspiration to go, to go new build, ground up? Was it a matter of just the numbers? Did you see somebody else doing it? Yes, I am chasing
IRRs. Definitely, I'm chasing IRRs here, but also it's a confluence of so many things, right? So like I was saying, right, in 2018 or so, I live here in Plano, a suburb of Dallas, and they were building a bunch of new apartments. And I used to get postcards in the mail saying that, hey, this is a brand new apartments. The rent is $1,900. You get 2 months of free rent, or you get a TV, or you get a $1,900 gift card. They were really trying to move them. And I was telling myself, why are they building all these things when they're not organically renting, right? Why? I mean, obviously it tells that there's not enough affordability. And it's just not one instance. I used to get several postcards like that and never bothered to look into ground up development. But that is when everything changed after COVID, right? So after COVID, I mean, Dallas grows leaps and bounds after every recession. So recessions are the best things that can happen to Dallas. I mean, it's suddenly a biggest step up. Several companies try to move here, several people move here and suddenly put a strain on the supply here. So suddenly the prices go up. And we saw that happening, but never before we have seen this kind of a demand for Class A properties. And also the change, I understood as I become a much more savvy investor, I started to understand the lives of my tenants, right? Before it's all just numbers, but now I just try to understand who are these tenants, what's going on in their lives and all that. And what I have seen Class A tenants is several trends in the US, right? So there is a huge gap between haves and have-nots, and it's widening in this country, right? So the people who have college degree or some kind of skill labor, they're doing well in life. They're getting good wage hikes and everything. They're not stretched. They're not living paycheck to paycheck. But same thing cannot be said about the Class B and C tenants. That's the one thing which changed my mind, right? So I want to be able to give a $150 rent bump and not worry if he was going to move on me, right?
Yes.
I want them to say that, okay, I'll pay it, So those are the tenants I want to cater to.
Yeah.
And the second thing is in 2007, 37 million out of the 110 or 120 million households in the US had kids.
Wow.
Fast forward 10 years, in 2021, only 33 million households have kids. There's actually more dogs in this country than kids, right? So people are not having as many kids. Why is that important to me? Because there's no longer demand for these 3-bedroom apartments, so many houses and all that, right? So people don't need that much space anymore. And the second thing which is happening is people are getting married later. Single motherhood is exploding. I'm not here to judge this is right, this is wrong. No, that's not my business. But as a landlord, I need to know what's happening in the country so that I can cater to all these people with the correct product so that they fit like a hand in a glove rather than me trying to force them into a 3-bedroom when they don't need a 3-bedroom. Yeah. So when I understood all these things, what I'm seeing is, and also there is a huge interest from institutions, right? The pension funds, endowments, insurance companies, right? All these people, REITs, and they commoditized this housing. Never before was housing is traded like a stock, like a what do you say? Like a commodity.
Yeah, security. Yeah.
Right? So there's a huge push into a lot of money find its way into housing, whether you call it apartments or single family homes. But suddenly there is an uptick in the demand on the Class A product. So everything points to me and filtered into following point. Go cater to Class A tenants. They're doing well in life and they will continue to do well in life, right? So if my client doesn't do well, how am I going to do well? How are my investors going to do well, right? So that's the number one thing. And number two thing is insatiable demand for well-located Class A properties in the primary markets. I stay in my lane. I don't go into secondary, tertiary markets because I just not good enough to understand those markets. I understand primary markets, and so I stay there and I work with what I know, right? So those are the conditions which I have seen, and also the construction financing. Previously, they'll give you 60%, 65% loan, and that's it. You got to bring with the remaining 35. But now there's just so many debt funds out there, lenders out there. They're stacking up to 85, 90%. On the construction cost, but it only translates to 70% LTV. On a construction project, it might look like an 85% LTC, but the value, if you look at, okay, what is the loan amount divided by the value, it's only 70% or less. So the construction financing came through for us, and investors are seeing what I'm saying as well, even though they cannot articulate the way I'm articulating, but they know that something is wrong here, but Class A seems to be doing well and all that, right? So they're giving money for me to build all these properties. So it's a confluence of all these things where I just made a quick decision that, look, I got to exit these Class C and B properties and then go into ground up development.
So what do you attribute the Class A demand in Dallas-Fort Worth to?
So number one thing is migration, right? There's no two ways about it. Migration, we go by domestic migration, not so much international migration since 2016. If you look at the numbers, in the year of 2015, we got a million people, immigrants into this country. Yeah. I'm counting legal. I'm not sure what the undocumented is, but legal, 1 million. And then 2016, as soon as the administration changed, that became half. And then COVID came and half again, right? So even with all this big drop in the international immigration, but domestic migration has been very strong for the markets like DFW, Atlanta, Phoenix, and all that. So that was a big driver. And also recently I read a Moody report. Yes, people are coming to Dallas, but who are coming to Dallas? 83% of the people who moved to Dallas in the last 2 years makes more than $75,000. Now, who are they? If you're making more than $75, who are you? You're a Class A tenant or a home buyer. So Dallas is no longer that cheap, affordable city like it used to be.
Yeah.
Right. When I moved to Dallas, my 1-bedroom rent was like $600 in a very good place.
Yeah.
Class B plus, I would say, property in Collin County. Now $600, you don't even get a C-class Class A property, a C-class 1-bedroom property, right? So a lot happened in last 10, 15 years that I have lived in DFW. But now DFW is attracting these Class A tenants who either have a job here, but they no longer have to go to the office. They can work remotely, but they're choosing Dallas, which is central to the country.
Yeah.
And start to work here. And then also 2 years worth of kids moving out of college or moving out of because of the shutdowns and everything, right? Suddenly there's a push for all these people coming out of their parents' homes or coming out of the colleges, looking for housing, landing jobs. All these things. And one other big thing, COVID created distance in people, right? Previously, 2 people used to rent 1 2-bedroom, then 2 separate 1-bedrooms. Right. But now COVID, right? I mean, look, he might bring somebody to my apartment. He might infect me. I want space. Right. So roommates started separating out. So the household creation was on overdrive. Several factors, right? And then I heard that I don't have numbers or quantities to prove this, but there was a spike in, domestic violences and then separations and all that kind of thing. So every little thing adds to a new household creation, which just exploded in all these primary cities, creating this acute demand for Class A properties.
Yeah. Yeah. I was thinking COVID too, when I asked the question, because there was such a massive movement towards working at home.
Yeah.
And so people need their own space. They're spending, hundreds of hours a week in their own space, or, maybe a couple hundred hours. I don't know how many hours there are in a week. I'd have to do the math, but they're that home environment all of a sudden became so much more important because of the fact that people were working at home. And so, and a lot of times people need that second bedroom as an office. And like you said too, people just kind of spreading out, not wanting to live in such high density environment, but wanting their own space. And look, there's a reason why it's a primary market. And I think it's like, I want to say the 3rd or 4th biggest city in the country, if I'm not mistaken.
It's the 4th biggest metro.
4th biggest metro, yeah.
After New York, LA, Chicago, and then Dallas. We got about 7.5 million. And by end of this decade, we'll hit 9 million people.
Yeah. And the economy there is very, very good. Very good. There's a lot of Fortune 500 companies that have relocated there. There's just a very diverse economy that's not unlike a lot of other Texas markets. It's not dependent on oil or gas.
Absolutely. No one sector makes more than 10% of the employment.
Yeah.
So if you look at Houston, it's heavy on oil.
Yeah.
If you look at San Antonio, it's heavy on medical. If you look at Austin, heavy on tech. But Dallas has a little bit of everything.
Yeah.
Mostly it's a financial center of the state. But we have finance, we have more tech jobs than Austin. Right. But we're not known for tech.
Right.
In the actual nominal number, we have more tech jobs in DFW than Austin, but it's not known for that. And a ton of financial services. And then we have a little bit of oil in the Irving area. It's a beautiful economy here.
Yeah. Yeah. It's a good place to be. I know. And there's a huge amount of people in Dallas that are not from Dallas that relocated there and moved there. I know that's true. And I also know it's a very young demographic.
Yes.
That's moving there.
And we have land. The day we ran out of land is when the growth will stop. And the way Dallas is located, where you have Dallas here, Fort Worth here, everything in between is fair game. Everything outside is fair game for development, for the future development.
Yeah.
And we have like a dozen, just on the Dallas side, we have like a dozen job centers. Now, when I say job center, DFW, Dallas downtown is just one of the dozen job centers, just one. Yeah. There's another 11 job centers in DFW. And that is how you have to be spread out with different job centers, different ecosystems. And that is what brings people here, enough land for people to build an office, bring jobs, enough cheap housing available for their employees. Look, Toyota brought 7,000 or 9,000 employees from Irvine, California to here after staying in Irvine for like 150 years. Yeah. They came here, they looked at it, it's like, look, this is where I'll put office. Okay, I have enough land. This is where all my employees live. This is where my execs live. Yeah, I can imagine them living here. And then they move here, 9,000 jobs.
Yeah,
right? Wow. This is how companies think. Yeah. Not just their company, but where will my employees live and will they thrive here?
Yep. Yeah. Well said. And you know, that job market, guys, for listeners, like your job market and your growth factor, your population growth are two huge things you want to be looking at when you're picking markets. You can't mitigate a bad economy or a bad job market or a non-diverse job market, like you said in Houston, for instance, you know, places that are dependent on oil, which is, you know, somewhat volatile in nature. So both literally and figuratively. Okay, so let's talk about ground up. First thing that comes to mind for me is that you have to have a great builder partner, I would think, that you're working with to get these projects done. And it seems to me like that could be make it or break it right there. Like the person pulling the strings on supervising the construction and coordinating the construction and managing it. That really is your key person, your key group. And so, you know, tell me a little bit about that. Did you go out and interview a bunch of construction firms, or how did that work?
Absolutely. So there are two roles in this, right? When you're trying to do ground up development, one is developer, one is GC, right? General contractor. So general contractor is the one who actually goes out, get the bids from their subs, right, and supervise the work and all that, right? They do all the grunt work. And developer, our job is like, we are like, think of us as a quarterback, right? So you are in the middle, you throw the ball, right? But you are responsible to get the game moving forward, right? So developer is the one who locates the land. Developer is the one who arranges financing, raises equity, hires a GC, or keeps investors happy with the updates and everything. So we are that, like a sponsor.
That's you, right? Yeah, that's
me.
you.
So what I did is got myself another developer partner, because there is no better way to mitigate risk in ground up development than working with somebody who have experience doing it several times over decades, right? So I got myself two different partners. I do one set of deals with one partner, one set of deals with another partner, just so that I don't overload any one person, right? So I went and got myself a couple of partners to, who have at least 40 years of experience. I went on looking for somebody with 20 years experience, but I found people with 40 years experience. And one of these partners actually built like 9,000 apartments for a REIT and all that, right? So I brought them in as a full partner. You can also actually treat them as a vendor and just pay them a fee and all that. But no, I brought them into the fold because I want them to be married to my projects, just walk away whenever they want to, right? So that is how I was able to scale, because I'm able to start. My very first property in ground up development was 156 units. Second property, 338. Right? I mean, I did not start with 20, 30, 40 units. Nothing wrong with that. It's just that, want to get this thing done while we're still young, right?
Right.
So wanted to start and have that scale from the get-go. And also, like I said before, right, in apartment business, the bigger it is, the safer it is, because you need that economies of scale, to turn a decent enough profit for you and your investor.
Yep.
And also one thing which fascinated me about development is, look, when you buy an existing apartment complex, of course you work on it, right? You do that value add and all that. But
Yeah.
for the most part, the market, at least 50% of it is market. The market has to carry you in order to create value. Of course, you do your job, and then the market has to carry you as well. But in ground up development, what I have seen is I create value for me and for my investors with these two hands. I go to work every single day and bring this property up out of the ground, and that creates the value.
Mhm.
Now, if market moves like it did in the last 2 years, right? Suddenly, the cap rates get compressed or whatever, right? That's gravy for me, but that's not a main way of creating value in the development. I control the process. Let's say if there is a cost overrun, I can tweak few things, work with my architect, do value engineer, tweak something. So that is me actively working on my project to create value for me and for my investors. And I like to be in control that way. So I really like development that way. But yes, to answer your question, I brought in a couple of very experienced people who is helping me to scale and getting these projects done.
Yeah, that's so smart. And I mean, Venkat, congratulations. Good for you for embracing the teamwork aspect of this and the partnership need to do these sorts of things. And, listeners, again, this is a team sport, whether you're doing a new build ground up or you're doing existing value add projects, especially when you're starting out and you're doing projects that are new in nature to you. Having that, in Venkat's example, 40 years of experience, behind him, backing him up, making sure he doesn't make any mistakes, adding tons of value to the strategy and the business plan. You can't duplicate that. And it's so valuable. One of my mentors, Tim Bratz, shout out to Tim. He says it's better to have a slice of a watermelon than all of a grape, And so what you've done is you've created some big watermelons, man. And you've got a nice big chunk of each one of those. And look at you now. I mean, you're rolling. So how many different projects?
And one other advantage, which I haven't mentioned, actually, I would actually say that other than having experience, the next biggest advantage of working with a very experienced individual in the team is this is the day, even today, there is an acute shortage of skilled labor.
Yeah.
Everywhere.
Yeah.
Architects, civil engineers, even those included, right? So today, if you're getting started, you try to call an architect and hire somebody, they'll say that, call me after 3 months. They just don't have time.
Right.
But let's say if you have your partner who worked with them for 40 years, call them and say, oh yeah, Mark, we'll give you an appointment tomorrow.
Yeah.
Right? It's night and day difference.
Sure.
There was a seller who gave me a 7-acre parcel in Round Rock in Austin on Highway 35. So he sold me this property and I said, man, why are you not building? You got it rezoned. And he said, look, Venkat, I called this particular architect that you're working with and they wouldn't give me attention. They said, call me after 3 months and 4 months. And I couldn't think of any other reason other than that I haven't built anything. This is my first property and they don't want to talk to me. Right? It's like they know everybody's stressed for labor, right? So they want to work and service those strong relationships rather than making new ones.
Sure.
So in that aspect also, to simply getting things done, you need these relationships.
Has that labor shortage, has that been your biggest challenge or what? I mean, what challenges have you faced along the way with your new build?
So yeah, material changes. Lumber has been a big issue, but then that went away, right? Before COVID, lumber used to trade around $300 to $400 per unit, which is 1,000 board feet of lumber, and then it went to $1,650.
Wow!
Now it's like $450.
Wow!
Right? So it came back almost to where it is. So that problem went away, but there is still concrete. Right, concrete you suddenly got so much expensive, and the vendors are just giving us keeping us on a diet. Say, let's say that we need 10 pours this week. They'll say, oh, we'll give you 3. So
Okay.
it adds more time to the project, right? I mean, the pref that we have to pay to the investors, everything goes up, the cost goes up. So that has been a pain, but that is slowly getting alleviated because even the material, right? Even the material is also expensive. But China, who consumed almost like 75% of all the concrete in the world for the last 20 years, is imploding. Like they have just so many, like 5 million units, unused units sitting there, half built, and even the government is actually bulldozing them down, raising them down, and a lot of going on over there. So that will send some of that concrete our way so we can use it on our projects at a decent price. So that is coming well. But yeah, other than that, most of the delays that we are seeing is that the vendors, the architect and civil engineers, they're doing the best they can, but it's not like before. They're stressed.
Yeah. So are your projects taking longer than you projected when you penciled them, or how is that going?
So what we did is, in Dallas, once you have entitlements, in order to design the project, drop the construction documents, get the permits, build it, lease it up, and sell, it used to take 3 years, tight 3 years. Now I'm telling my investors 3 years and 9 months.
Okay.
I added 3 months extra to the 6-month design process. I made 6 months into 9 months. And the construction process used to be 18 months. I made it 24 months.
Okay.
So 3 years and 9 months is the new norm.
Okay.
That I'm telling my investors. So yeah, I mean, if you think about it, it added about 30% more in time.
And do you start paying your pref to your investors upon completion?
But I don't do that because look, where is the money coming from? I have to raise money from them, escrow it, and pay them that. Nothing wrong with that. It's just that I chose not to do it. And the pitch I give to my investors is, my investors started with me as these are all IT people, because they can relate well with me because of my background, referrals and all that. I don't do any, I have till date raised around $146 million. In 2022, I raised 40 plus million, or 40 to $43 million this year. And traditionally, my investors gave me money to invest in value-add apartments. But the pitch I pitched them since last 2.5 years about apartments is, look, the prices have went through the roof, right? The existing apartments. And now the interest rates are so high, taxes, insurance, and all that. After all this, maybe I can pay you 2, 3, 4% cash flow, right? If you still want me to go do those, and I can do those. Now, what does that change in your life? That 2%, 3% cash flow on $100,000, $3,000 is distributed over 4 quarters, $750 check. I mean, what is it changing? You can't even take a decent vacation with that. But give me your money, and let's go build these apartments. And I target 21 IRR for my investors. If it doesn't pay 21 IRR, I won't do it. I'll pass on the project.
Okay.
So 21 IRR doubles investors' money in 3.5 years.
Yeah.
And they are in a Class A property in a primary metro, well located, REIT grade product here. So you have to think about risk adjusted also. Yeah. Right. Even today, somebody can go and make the 21 IRR on a C-class property, right? With some decent cash flow and all that, but they're far and few between, right?
Yeah.
So, but here in a Class A, consistently, we can do, if you stick with me, we can continue to do one after another. You can make $1 into 2, 2 into 4, 4 into 8 in roughly 12 years, 11 to 12 years.
Yeah. Yeah.
That changes your life. Maybe you can retire. Maybe you can buy a jet. Maybe you can pay off your kids' student loans or whatever. Not this $700, $750 check on a $100K investment every quarter.
Yeah.
So that was the pitch, and it resonated very well. Value add, depreciation, not paying taxes, mailbox money, it has its time.
Yeah.
And I think most of it has passed.
Okay.
So I recognize that, and I moved on to the next phase of the life where we have to double investors' money and not so much cash flow.
Are you able to build for less than replacement cost? In other words, when you look at, let's say, a existing Class A building that's maybe 3 years old, are you able to build for less than what you would pay retail for a new building?
Yes, that is where the profit comes from. It wasn't the case before COVID.
Yeah.
Before COVID, let's say it costs you to build apartments at $200,000 a door. Why build? You can buy something existing, like a 5-year-old, 6-year-old property for like $150, $150,000. You know what? There was no incentive to build. That's why I never looked at it before COVID. But after COVID, the plan is to build, let's say, at $200,000, right? I mean, the idea is to sell it at 250, 260, 270. And this is happening because of this cap rate compression. That's the number one reason, right? No denying about it. And the second thing is this became a commodity. People are piling in.
Yeah.
And if you see the REITs, right? If you see I was seeing JP Morgan Chase's report, last 20 years, even if you see stock markets, who did well, there is a chart here, S&P somewhere here. And then the leftmost item was REITs.
Yeah.
The people who buy these apartments and hold it in their portfolio over a 20-year period, they're beating every other sector, including tech.
Yeah. Yeah.
Right. So they definitely know what they're doing. So they're doubling down on it. Yeah. Right. So that is where the demand is coming from for the Class A properties.
Yeah. Gotcha. Well, unfortunately, we're running up against time here, Venkat. This has been very enlightening for me. I always love hearing from people that are doing things differently than how we're doing them. You know, we're in the existing space right now, and we have looked at some new build projects, but haven't taken the leap yet. So I really love your story, and I love, you know, you've only been doing this 6 years, and you're absolutely killing it. Let me just ask you one last question before we wrap up. With, you know, when you sold your 3,000 units last year, that obviously produced a lot of dry powder, so to speak. Are you what are you doing with that? Are you holding on to it? Are you waiting?
No, I need all that cash. See, that is how I did, right? So first I went to a W-2 job. I brought money. I put it in single families, grew the money, took that money, put into multifamily, because as a sponsor, you have to put like 10% of the money, right? So I did all these value add deals. I got money back, and now I'm putting it into development. So every passing, development is not cheap, right? So even before you bring in investors, you may have to spend, like including earnest money and everything, you probably have to spend like $500,000 on a project. So you need not deep pockets, but you need fair amount of money. And I'm doing 6 projects now.
Yeah.
So think about all the outlay, right?
Yeah.
So I still do value adds here and there if I see something decent. But for the most part, I need all this money to actually get all these projects going. But like I said, right? I mean, I'm the ringmaster, you know, I'm the quarterback on all these deals. I bring in people to play a specific role, and I compensate them by sharing my pie, like you said, right?
Yeah.
I'll share my water melon with them.
Yeah.
But I still am the guy who's actually holding all the cards here.
Yeah.
And
awesome.
Also what again inspired me on this development is Sam Zell. I'm not sure if you know who Sam Zell is, but he's the chairman of Equity Residential, been in business since 1960s. Super smart guy. He owns like 80,000 units, Class A units.
Wow. Yeah.
This is what he said. If you want margin, do hard things that not many people do.
Oh, yeah.
Margin.
Yeah.
McDonald's, you make like 10 cents on a $2 burger. Steakhouse makes $100 or let's say $30 on a $50 steak, right?
Yeah.
So which business do you want to do, kind of thing, right? So, and as I grow old, I'm in my early 40s now. So I want to do few quality projects with a lot of juice in them, rather than 30 small projects with you know, razor thin margins and all that.
Sure.
So that is it. I mean, for every person who can develop existing properties, there are 100 people who are doing value add. Right. And I want to actually climb this ladder chain of value and even do better things like I want to put together mixed use developments. I want to start with land now, right? I want to buy raw land, work with city, put PDs. I also already did 2 land deals, a 54 acre and a 124 acre. Mm-hmm. So that is where the margins are. It should not be easy. It should be complicated. It should be tough. And thank God it is that way.
Yeah.
Otherwise, everybody will do it and there won't be margins.
Right. Yeah. You got to be willing to fish upstream from where everybody else is fishing.
There you go.
That's for sure. Yeah. Well, Venkat, this has been great. If listeners want to reach you and network with you and find out more about your opportunities, what's the best way for them to reach you?
Well, they can email me at Venkat, Venkat, at Stryker Prop, Stryker prop.com, or they can reach me on my phone at 281-727-9238, or they can visit our website at Stryker Properties, Stryker properties.com.
Yeah. Yep. And just to repeat that for you guys, it's Venkat, Venkat, at Stryker Prop. So STRYKERPROP.com. And I'm sure Venkat would love to hear from any of you guys that are interested in this space. So Venkat, thanks a lot. I have a lot of gratitude for you being on the show and kind of opening your playbook up and really being an inspiration, educator for my listeners and myself. So really appreciate you.
Absolutely. Thanks for having me.
Yeah, you bet. And I wish you all the best. Let us know how we can ever maybe be helpful to you, and let's stay in touch and keep growing together. So, so wish you all the best. And listeners, thank you. We love you guys. So happy that you joined us and listened to the end of another episode here. You guys are doing good things and keep it up. So we're doing 2 of these a week now, 2 episodes a week. So we'll see you in a couple days on the next episode of the Apartment Gurus. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.